You've got red numbers, green numbers, and a bunch of people in suits using words you've never heard of. Welcome to the stock market. For some of you, this is enough to scare you right away from the stock market, but I urge you not to. Once you break down all that bull, which we will do today, the stock market is a very powerful place. You've landed yourself on the complete beginner's guide to the stock market. In this video, you will learn about what the stock market is, how it works, and most importantly, how to make that money. But hey, let's not get too ahead of ourselves. Welcome to the Money Playbook, where our aim is to help you, the younger generation, learn about the huge world of money. If the world of money and finance excites you, or if you have a passion to learn more, make sure you are subscribed and just destroy that like button. So where do we even start? This video could literally go on for hours, but I refuse to let that happen for your sake and mine. So straight away we will answer, what is a stock? Well, a stock is, put simply, a tiny part or a percentage of a business. When someone says that they own a stock, they will generally be indicating that they have part ownership in a business. The term stock is also linked to the word shares. They are used interchangeably. There is an ongoing debate on the exact meaning between the two terms, but essentially they both mean part ownership of a business, and that's all we really care about. It is important to note that unless you're a mega wealthy, cashed up superstar, your ownership in a select business is going to be tiny. So now, how does the stock market work? Well, it's pretty obvious, but not every business is at the same level. Tech giant Apple is just a little bit bigger than that corner milk bar store. And this is why not every stock is priced the same. The value of the stock is based off two things essentially, and that is the value of the business, whether that be how profitable it is or its potential to be profitable, as well as how many shares or stocks the business has up for sale. Big companies can have millions of shares. These two components make up what is called market capitalization. Basically, this is the value of the company as it is publicly traded and is calculated by how many shares publicly available multiplied by the price per share. So let's say company A has 100,000 shares publicly available at a price of $2.50 a share. Their market capitalization is $250,000. It's quite simple. Now I'm sure you're shaking the screen asking me, well, why would a business want to be publicly traded on the stock market? And I'm so glad you're asked and you're keen to learn. There's many ways a business chooses to enter the stock market, but the biggest reason is to raise capital. And for you sitting there confused, scratching your head to what capital is, well then that's okay. Capital is pretty much just cash, or the company's current assets. So, when a business decides to go public, they essentially sacrifice a fraction of their company and get that value in cash. Companies can do this to expand and become bigger powerhouses, which ultimately increases their value and hence makes their market capitalization bigger. Let's quickly recap what you have learned before we continue. So a stock or a share is a part of a business that you can buy on the share market, making you a part owner of that business. We know not all businesses are the same, and that is reflected in their market capitalization, which is the amount of shares publicly available by that business multiplied by the price per share. Okay, so now we have basic knowledge. Smash that like button and let's continue. Now it's good to understand why a stock price would increase or decrease. And although you may think, strap yourself in, this is going to be confusing, it's not. The stock market works on simply a supply and demand system. That means if more people are wanting to buy a stock, the stock price will increase. And inversely, if everyone wants to sell their share in a business, that stock price will decrease. And that is all. Demand for a stock can increase due to inflation, businesses increasing profits, or expansion, or even the business's future potential can drive people to want to buy that business, in turn increasing the price of the stock. Oppositely, if a business's future looks bleak, if their profits start to decline, or if they get into legal or financial trouble, etc., people may want to look to get out of that business, driving the price right down. So as you geniuses can probably assume, the way to make money from the stock market is simply buying low and selling high. But it's nowhere near this easy. Otherwise, everyone will be sitting in their yachts, cruising the seas. This is what leads me into the next part of this video, which is, what are the dangers of investing in the stock market? So to a beginner and amateur, stock can be very dangerous, pretty much gambling, due to an investor's lack of knowledge and the extreme volatility of the stock market. Volatility is a word used to describe dramatic changes that you see in the stock market. Now when it comes to investing, you essentially have two approaches, a long-term and a short-term approach. As a short-term investor, your risk is much higher than a long-term investor, typically because short-term investors are very speculative. They are assuming that over a short period a company's stock price is going to increase, hence why they buy, then sell when the price increases. Whereas if you're investing for the long term, which I unprofessionally encourage, you are banking on the historic stock market return, and that is on average 10%, give or take a few percentage depending on who you ask and what market they're in. Meaning your investment portfolio in the stock market, if invested wisely, will increase on average that 10% a year. Now warning, this is over a long period of time, not 1, 2, 3 years. We're talking more 20 to 30 to 40 years. where short-term volatility is just eliminated. And to add, not every stock will increase by this 10% each year. It is the overall market, hence some stocks may well and truly exceed this 10%, but some stocks may just plummet and leave you with an empty wallet. It's a great time to add that the Money Playbook is not liable for any losses that may occur. It is advised that you seek a legal financial advisor before investing in the stock market. Now, if that hasn't scared anyone off, let me know in the comments if the idea of investing in the stock market interests you. And if it does, well then just wait till you hear this next part, which is, what is a dividend? You may have heard this term thrown around like crazy in the investing world, and it is essential to understand. A dividend is a reward that businesses give their owners, shareholders, for owning shares in their business. This comes mostly in the form of cash payments, but is not restricted to just that. Dividends can also be paid in the form of rewarding shareholders with more shares in that selected business. This is what is called a dividend reinvestment plan. This basically means the dividend cash that you would earn with that company is automatically reinvested into buying more shares with that company. This means as the amount of shares increases in your portfolio, so does the value. Now, dividends can be paid out in quarters, half yearly, yearly, per month, or regular payments where there is no set schedule. This all depends completely on the business's choice. A company's dividend differs from company to company. Let's just whip out two quick examples. Apple and Coca-Cola. As it stands when I'm doing this video, Apple has a dividend yield of 0.69% and Coca-Cola has a dividend of 2.9%. This meaning, let's say if you had $100 invested in both of these companies, every year Apple would pay you 69 cents and Coca-Cola would pay you $2.90 for doing absolutely nothing. Yes, for doing nothing, and hence why dividend paying stocks are a great passive income source. Now you may be asking, well, why wouldn't I just buy stocks in companies that pay the highest dividend? And that is a very good question to ask. And that is because stocks can be categorized into essentially two major categories, and that is the dividend paying stocks and the growth stocks. Growth stocks are stocks that will generally put all their profits back into the business, hence they're not able to give back to their shareholders. But where they excel is the price of their stocks. By putting their profits back into the business, they will expand, and if done right, their stock price will increase, and hence the value of your portfolio will increase. Whereas a dividend stock can still experience this capital growth, however, it is generally nowhere near as rapid as a growth stock. This is because dividend paying companies choose to pay out their profits to the shareholders. So it really is a win-win for both sides or companies, depending on how you look at it and how you want to invest. So if you've gotten this far in the video and have learned something new today, make sure you smash that like button. It would mean the absolute world to me. And if you haven't, feel free to just abuse me in the comments for absolutely wasting your time. It wouldn't be a complete guide if you didn't come out of this video not knowing where to get started. Now there is two ways you can essentially buy these stocks and shares, and that is through an online brokerage service or by seeking out an actual broker. Most of the major banks offer an online brokeraging service. This is where you can have complete control over your decisions, and hence the brokerage fee is much less. You can place an order or a trade for as little as $15 when doing this way. However, you are buying by yourself, and you will feel like the new guy on the block. And by doing this way, you can obviously guess that the risk is much higher, and it is advised that you do extensive research or preferably seek legal financial advisor. And the other way you can buy stocks and shares is through an actual broker. Now they can give you some certain advice on your investments, however they have to claim if there are any incentives involved for what they are recommending you. Of course, they will charge, and much more than what an online broker will. Nothing's free. Normally they will take a certain percentage of what you're investing, or you may find some brokers that have a set price. So I urge you to Google and research a bit more into what avenue would best suit you, whether you're a complete beginner or you have some type of knowledge in the share market. And with that, we will finish the video here. Let me know the one thing you've learned from this video in the comments. But remember guys, if you want to learn more about financial freedom, increase your financial literacy, or help to understand the world of money, make sure you're subscribed to the Money Playbook and you turn that like button blue.